Hey guys, how's it going? My name is Hamish and today we're going to be analysing applied materials, and you're going to want to stick around to the end in this one because, spoiler, I think the numbers look great and I think at the current stock price it's looking very attractive as a buy. As per usual in my analysis videos, I'm going to start off by giving you a brief description of what the company is and what they do, followed by the 4 key areas that we look at for analysing the strength of a business, which is the economic moat of a business, the ROIC, the debt levels in a business, and the 4 key growth numbers, which are sales, earnings per share, equity, and free cash flow. And after that, we're going to be looking at the value of applied materials, putting a price on how much we think applied materials is going to be worth in 10 years, and then discounting that back to the present day so that we know how much we're going to pay today. And I'm actually going to introduce a new method of valuation, which I like to call the value matrix. Just before we get started, I need to say that I'm not a financial advisor and I'm certainly not your financial advisor. So everything here is just my personal opinion and for entertainment purposes. If you are going to be investing in applied materials or any other stock for that matter, make sure you do your own research before you go ahead and invest. Chuck a like on the video if you do enjoy because it helps me out a heap. But for now, let's jump into it. So what is applied materials? Now, the company was founded in 1967 and the core of their business is supplying the equipment and the materials for the manufacturing of semiconductors, flat panel displays, and solar products. Some of their biggest customers include Taiwan Semiconductors, Samsung, Intel, and Tokyo Electron, and that's with TSM and Samsung making up 21% and 12% of applied materials total revenues respectively. So that leads us into talking about applied materials economic moat, and this is an area in which I think AMAT is quite weak. While they do supply parts for some of the biggest tech companies in the world, 2 of their customers make up 33% of their revenues, which means if they lose one or both of these customers, their revenues and their profits for that matter will be significantly hurt. So this increases the risk and the uncertainty surrounding what their future earnings will be, and it's something to be aware of if you're thinking about investing in applied materials. Next, we want to have a look at the ROIC of applied materials. That's the return on invested capital, and over the past 5 years they've averaged a return on invested capital of 14.5%, which is excellent. And in the last year they've been able to get a return on invested capital of over 25%, which is amazing. It means that the management is finding really great projects to invest in and they're getting really great returns on the money that we've provided to them and the money that they've gotten from debt. Speaking of debt, now let's have a look at the debt levels within applied materials. And if you've seen my other videos, you would know that I like to look at the 2 key ratios, which are the current ratio and the debt to equity ratio. So let's have a look at those. So the current ratio for applied materials is 3.14, which is well above our requirement of a current ratio being above 2. And for the debt to equity ratio, their debt to equity ratio is just over 1, which is okay, but we like to see that the debt to equity ratio is less than 0.5, meaning that the company is funded 2 times as much by shareholders than it is by debt. However, a debt to equity ratio of 1 is okay, and I'm okay with that. So that brings us to the fun bit, the growth numbers. Now let's have a look at these numbers and see if they fit our criteria. So as you can see, if we're looking at the 9-year numbers for applied materials, the earnings per share is excellent, 18.2%. The others are a little bit low. Free cash flow is about 10%, which is what we look for. We look for 10% or above for all of these numbers. Equity growth has been pretty slow, but I would put that down to them making a lot of investments and a lot of acquisitions in order to grow their business. And their sales growth has been about 7%, which is not too slow and not too quick. I'd like to see it quicker, but if we look into the 5, the 3, and the 1-year numbers, we can see that the numbers have been improving a lot. And for the earnings per share, the numbers have been excellent, well over the 10% that we require. For equity, they've been a little bit slow. This year's was really great, but we like to look at long-term numbers, so I'm still not super happy about the equity. Free cash flow is excellent, and sales growth has been very good over the last 5, 3, and 1 years. So overall, I think the growth numbers for applied materials are very good. However, because there's some inconsistencies, we want to make sure that we're being very conservative on our growth numbers because while yes, the earnings per share is growing at 50% or 100% per year, we can't put that in our valuations because we don't know if that's going to continue over the long term, especially if the sales growth has only been about 6% over the long term or 7% over the long term. That's the rate at which this business is growing over the long term. So we want to use a number that's probably closer to in the 10% range rather than anything much higher than that. So that brings us to the valuation of applied materials. And in the past, what I've done is I've estimated a single growth number, and I've also estimated a single future PE ratio, which gives us a single price that we think the stock will be at in 10 years, one price, and then we just discount that back, and then we can find out how much we should be willing to pay today. But instead, today we're going to be looking at what I like to call the value matrix, which takes a range of PE ratios and a range of growth numbers into account so that we can see what our possible returns will be. So if we're having a look at the matrix, we can see that across the top we've got the different PE ratios that applied materials may have in 10 years. So it might have a PE of 10, or it might have a PE all the way up to 30. And along the side we've got the growth numbers. And I've said that I think applied materials will grow at somewhere between 5 and 20% per year over the next 10 years. And I'm going to make a video talking about exactly how I made this and how you can make this, but essentially the numbers in the middle tell us what return we would get if applied materials had a certain PE and a certain growth number over the next 10 years. And those percentages in the middle are a percentage return per year for 10 years. So for example, if we bought applied materials at the price that it currently is, which is about $53 per share, and let's say that it grew at 9% per year, and in 10 years the PE ratio is 20. That would mean that over the next 10 years we would make a return of 10.31% per year, which is a really strong return. However, I've got that in yellow because it's not quite the 15% return that we require. So I like to use this matrix because it tells me not only what I can expect to get, but if I fall short, what am I going to get? And if it far exceeds that, what am I going to get? And basically this is great because if we have a look at applied materials matrix again, we can see that there's only one circumstance in this particular matrix in which we get a negative return. And every other situation is at least a positive return, and it's at least better than having the money in the bank at that time, for example, because you might get 1% per year in the bank, and even at a PE of 15 and at 5% growth, we're still going to get 3.24%. Now we can go in and change the share price, or the price that we will be paying for the stock, in order to see what different returns we will get for the different prices that we pay. So as you can see, if we were able to pick up shares of AMAT for $35 per share, there is no negative returns, and some of those positive returns are absolutely unbelievable, especially in the top end. If we got 16% growth and a PE of 25, 25% per year compounded over 10 years is over 8 times our money. I think it's about 10 times your money in that period. So if you were to get that return and you had invested $10,000, in 10 years time that $10,000 would have grown to about $100,000, somewhere between $80,000 and $100,000, which is amazing. But remember, this is buying it at $35 per share, not the current stock price, which is about $53 per share. So from this matrix, you can work out whether or not it's worth the risk at the current price, or whether you would want to be waiting till the price falls a little bit before you start to invest. So that's all for today, guys. I hope you enjoyed this video of my analysis of applied materials. If you think applied materials is a buy or a sell or a hold, make sure you let me know your thoughts down in the comments below. If you did enjoy, make sure you leave a like and subscribe if you haven't already. I like to make these analysis videos as often as I can, even though they take a lot of work to put in. I think they provide a lot of value to you guys, so I try to do as many as possible. And if you have any stocks that you want me to analyze, make sure you leave them down in the comments as well, so that I can chuck them on my list and analyze them for you guys in a video like this. But that's all for today, guys. I hope you have a great day, and I'll see you in the next one.